Welcome to Markets Now. I'm Michelle Rook along with Arlen Studerman with StoneX, and we closed out the week higher in livestock mixed in the grains. And Arlen, let's talk a little bit about kind of the theme for the week, which kind of was risk-off recessionary talk, wasn't it?
Yeah, it really was. And the meeting with the Federal Reserve on Tuesday and Wednesday, coming out with their statement and press conference on Wednesday, really amplified that. And the fund managers just look at all the supply and demand fundamentals through the lens of recession. And to them, that means recession, consumers consume less, they buy less, that means less demand. That's more true for the energy-based commodities than it is the food-based commodities. But it is a concern that we certainly have to keep. But it nonetheless, it affects how the fund managers read those very same supply and demand fundamentals differently than if we were the opposite were the case. How long will that last? Well, probably it's going to last until the trade starts to think we're at peak interest rates. They don't have to see interest rates going down. Keep in mind the outside market's a stock market that really sets consumer sentiment to a great extent, is a futures looking market just like our green markets are. And so when the time comes when Wall Street thinks that we're approaching peak interest rates, they'll quit fearing them and they'll start anticipating lower rates, however long that may be in the future. And that should change the sentiment on Wall Street at that point. And that could be any time in the next year that we see that. But until then, it's probably going to be looking through a bearish lens.
So let's talk about some of the different commodities. First of all, soybeans. We seem to go up to the upper end of the trading range. We hit resistance, we can't get through it, and then we kind of retrace from there. And then there's this tug of war between meal and oil and a lot of this spread unwinding. What wins out here coming up?
Well, unfortunately, it's China is going to be the big impact in the near
Okay.
term. Yes, we're going to be keeping our eye on the drought in Argentina, but China's the demand sector right now. And they see no reason to really chase the market when they know we're going to start harvesting new crop Brazil beans here in the next 2 weeks. And it takes 45 days for those beans to get to the ports in China once they get to the port and loaded in Brazil. But they've got a lot of those purchases made already. So they're just trying to close the gap. Then they know cheaper beans from Brazil will be available to them. They've got most of that gap filled. They may need another 500,000 metric ton to 1 million metric tons. And so they're buying the dips and then backing off whenever it gets close to 1490 basis the January contract. So without knowing that that demand is limited in scope, no one really wants to chase the market at this point. They don't have a reason. Brazil has a big crop and Argentina has a small crop. The two balance each other out to an adequate crop at this point. And so the upside continues to be limited for soybeans.
Yeah. Corn market also kind of range bound here as well, and demand, obviously, exports and ethanol have been a little bit of a concern here, but yet we have the Argentina crop and South America in general, something that we're watching. And so again, how long does that tug of war last?
Yeah, when you look at the corn charts, tells you the behavior. Longer term, we're in a channel going down. Over the past week, we bounced toward the top of that channel. But overall, it's still a bearish story because the market's interpreting everything through a bearish lens. And that's likely to continue until something happens to shock this market. Right now, the one fundamental they focus on more than anything else is exports. Exports of corn have simply stunk. There's no other way to say it. They've been poor. That's allowed domestic demand to remain strong, and basis is still very strong, especially in the West. Although it's came off its highs, it's still at historically very high levels because supplies are tight because of the drought in the Western ag belt this growing season. But the board is very unimpressed at this point, and something's going to happen to change that dynamic.
Yeah. And of course, the wheat market has been obviously a factor on corn as well. But let's talk about wheat because we're going to have a higher weekly close here for the first time in a while. Is that market bottoming or not?
Yeah, higher weekly close, but still just taking it up to the top of the channel that's trending lower. So we really need to see that channel broke. We did see a sharp break in the euro market this last week. Europe's wheat market, U.S. wheat market was underpriced yet, so it didn't go down with it. It was able to get us a bounce. The question is the European market hitting a low? It's getting down where it should buy some demand, provides a little bit of support. So we'll see if we can get a little bit of support the next couple of weeks, albeit it's a difficult time to do that going into the holidays. But really, if you want to draw a fundamental story, there is, with the cold weather coming in, risking some winter kill where there's no snow cover. If you want to talk about the drought in the plains, hard red winter wheat crop, that's still a factor. But the market historically doesn't care about that until we get to February, March, and I anticipate that's going to remain the case this year as well.
Yeah, it hasn't felt like we've tried to trade weather in wheat. And in fact, I don't feel like we did in the cattle market this week either. And it sounds like those cold temperatures are going to be impacting cattle areas. We did have some steady to better cash trade this week. We haven't taken out the top side of the trading range here. Will we, do you think?
Well, we typically see the cash market drop off as we get into the last half of December. And instead, this past week, we traded pretty steady to the previous week, around 155 in the south, 155, 158 in the north. So it's held pretty well. We're seeing the slaughter rates back off. There's nothing unusual about that in the holidays. And so we'll have to watch those weights and see if we get behind in the near term. But of course, no one's too concerned about that, because in the first quarter next year, we're expecting beef production to drop by 5%, and that to grow to down 9% year on year in the last half of the year, down 8% year over year overall. So the market feels like we're going to be well supported. And in the end, then, even though beef prices, the last CPI report showed prices for the consumer were down 5% year on year, it's going to be very hard to hold those prices down in the year ahead. And now it's going to come down to simply, will the consumer pay it? Will we be in a recession that'll keep them from paying it? Will the economy be strong enough that the consumer be willing to pay it to support the higher beef prices?
Yep, supply and demand, tug of war there too. Okay, finally, hogs, just quickly. We did see a higher day on Friday. Was that all short covering, or are the cash and the cutout markets finally indicating they might be bottoming?
Well, that's been the debate, and that was a little bit of the market on Friday as well. But I think even a bigger factor perhaps was the cold weather. We're
Okay.
also starting to hear some disease in the farrowing barns and in the pig barns as well. But I think the weather was a big factor on Friday, and we'll certainly see that be a factor, I think, this coming week as well.
Appreciate your time. Arlen Suderman with StoneX and Markets Now.